When people first hear the word options trading, it sounds intimidating, almost like a game reserved for Wall Street professionals with complicated charts and endless financial jargon. But let's strip all of that away and break it down simply. At its core, a call option is nothing more than a contract that gives you the right, but not the obligation to buy a stock at a certain price, investment within a certain time. That's it. It's not magic. It's not gambling. And it's not a shortcut to instant wealth. It's just a tool, one that, when used properly, can give you leverage and opportunities you don't have when simply buying stocks outright. Here's the idea: when you buy a call option, you're basically saying, I believe this stock is going to go up, investment, and I want the right to buy it later at today's price. Imagine you're eyeing a house worth $200,000 and the seller agrees to give you the option to buy it within the next 6 months at that same $200,000 price. For this privilege, you pay the seller a small upfront fee, let's say $5,000. If the market value of that house jumps to $250,000 in a few months, you still get to buy it for $200,000 and instantly creating $50,000 in value. But if the house stays flat or even drops in value, you're not forced to buy it. You just lose the $5,000 you paid for the option. That's essentially how a call option works with stocks. Now let's talk about the trade-off. The beauty of call options is leverage. With a relatively small upfront payment known as the premium, you can control a much larger amount of stock. For example, instead of spending $10,000 buying 100 shares of a stock at 100 each, you might spend only a few $100s on a call option that gives you the same upside if the stock goes up. If it does, your percentage returns can be massive compared to just owning the shares. But here's the catch: if the stock doesn't move in your favor, that small premium you paid could go to zero very quickly. It's high potential reward paired with high risk. And you have to be okay with the possibility of losing the entire premium. To make this more relatable, picture it like buying concert tickets in advance. Let's say your favorite artist is performing and you grab a 100 ticket. Suddenly the show sells out and demand skyrockets. People are willing to pay $300 for that same ticket. Since you already locked in your ticket at 100, everything makes a good investment. You now hold something worth more than you paid for it. That's what a call option feels like when the stock price moves up. It's the value of having locked in a deal before everyone else realized how good it was. But here's where beginners often trip up. They see the potential for big gains and forget that options expire. Unlike owning a stock you can hold forever, options have a ticking clock. If your call option expires and the stock hasn't risen above your strike price, it becomes worthless. Another mistake is buying calls on hype without understanding the company, its fundamentals, everything makes a good investment, or even how volatile the market is. Options aren't lottery tickets. They're strategic tools that require timing, patience, and discipline. So if you're just getting started, treat options like training wheels. Begin small, use them as a way to learn, and always assume the money you put in could be lost. The goal isn't to gamble. It's to add a powerful tool to your investing toolbox. That investment, when combined with research and strategy, can help you take advantage of opportunities in the market. A call option, at its simplest level, is a contract that gives the buyer the right, but not the obligation, to purchase a specific stock at a predetermined price within a certain period of time. This predetermined price is called the strike price, and the date by which the option must be exercised is called the expiration date. Unlike buying the stock outright, where you immediately own a piece of the company, a call option is more like securing a deal in advance. It's the right to buy later at the same price, regardless of how much the stock might increase in value. To understand this, it helps to compare it to something outside of the stock market. Imagine you've been eyeing a car at a dealership priced at $20,000 in investment. You believe that demand for this particular car will rise in the coming months, and with demand, the price will too. Best when you negotiate with the dealer and pay $30,000 for the option to buy that car at $20,000 any time within the next 3 months. If 2 months later, that car is suddenly in high demand and now sells for $25,000 investment, your option allows you to buy it for $20,000, immediately locking in a $5,000 in advantage. If the price stays flat or drops, you don't have to buy the car. You simply lose the $100,000 you paid for the option. That's the essence of what a call option is in the financial markets. Except instead of cars, it applies to stocks. The reason call options exist is to give traders and investors flexibility. Some people use them as a way to speculate, betting that a stock will go up in price. Others use them as part of a hedging strategy, and protecting themselves against potential losses or trying to capture gains in a cost-effective way. What makes call options especially attractive is the leverage they provide. With a relatively small upfront cost, makes a good investment. Called the premium, an investor can control many more shares than they could if they bought the stock outright. This leverage is both the biggest strength and the biggest risk of call options. Investment. If the stock price rises above the strike price, the option becomes more valuable, and the percentage return on the premium paid can be enormous compared to simply owning the stock. But if the stock fails to move in the desired direction, the option can expire worthless and the entire premium is lost. To illustrate this, think of an investor who wants exposure to a stock trading at 100 per share. And buying 100 shares would require 10,000. Instead, they purchase a call option with a strike price of 100 that costs $2 per share, or 200 for the contract, since each option contract typically represents 100 shares. If the stock rises to 120, the option now has intrinsic value of $20 per share, or $2,000 total. After subtracting the 200 premium, the net gain is well, there's an 800. Compared to the 200 invested, that's a 900% return. By contrast, if the investor had simply bought the stock, the gain would have been $2,000 and on a $10 investment, a 20% return. The difference is staggering. Investment, and it shows why many beginners are drawn to call options as a way to maximize returns. But the risk is equally clear. If the stock had stayed below 100 by expiration, the call option would have been worthless investment, and the entire 200 premium would be lost, whereas owning the stock would still have some value. It's also important to understand that a call option doesn't force the buyer to purchase the stock. It is not an obligation, only a right. That flexibility is why the premium is paid in the first place. It compensates the seller of the option for taking on the potential risk. The seller or writer of the call option is on the other side of the deal, and they collect the premium with the hope that the option expires worthless, meaning they get to keep the money without having to sell any shares. At its core, then, a call option is about locking in the ability to buy something at a set price, regardless of how the market moves in the future. It allows someone to participate in the potential upside of a stock without committing the full amount of capital that buying the stock outright would require. For beginners, investment, it's crucial to grasp this basic definition and mechanism before moving on to more advanced strategies, because everything else in options trading builds on this simple foundation. The right to buy at a set price within a set time. When it comes to call options, the most important concept beginners need to understand is the balance between risk and reward. Options, by their very design, are leveraged instruments, meaning they give you control over a large position with only a relatively small upfront investment. This is where the potential for high reward comes in, but it is also the exact reason why the risks can be much greater than simply buying a stock. Imagine you buy 100 shares of a stock at 50 each. You invest $5 in, and if the stock rises to 60, you make 1,000. That's a 20% gain on your money. Now compare that to buying a call option on the same stock with a strike price of 50, costing you just 200 for the contract. If the stock rises to 60, that option is now worth 400,000, 5 times what you invested. The return is 400%, far greater than the 20% you would have earned owning the stock directly. This is the reward side of the equation, investment, and it shows why call options attract so much attention. They amplify the upside in a way that buying stocks cannot. But this leverage is a double-edged sword because it also magnifies the downside. In the example of buying the stock outright, if the stock falls from $50 to $45, your $5 in investment is now worth $500. You've lost $500, but you still own the stock, and it could recover in the future. Investment. With a call option, though, if the stock falls or even just fails to rise above the strike price before the expiration date, your entire 200 investment could vanish. This creates a situation where the maximum risk of buying a call option is losing 100% of your premium, while the maximum reward is theoretically unlimited because stocks can continue to rise indefinitely. That's the trade-off in its purest form, limited loss, but potentially unlimited gain. This sounds enticing, but the reality is that most call options expire worthless. The clock is always ticking because every option comes with an expiration date. Even if you are correct that the stock will eventually rise, if it does not do so within the time frame of your contract investment, the option still expires with no value. Time is not your friend when you are holding a call option. The longer the stock takes to move in your favor, the more your option loses value due to what is called time decay. This risk is invisible to many beginners because they think only in terms of whether the stock goes up or down, without realizing that timing matters just as much as direction. Another layer to this trade-off is volatility. Stocks that are highly volatile tend to have more expensive options because the probability of big price swings increases the chance of profit for the option holder. This means that when you are buying call options on volatile stocks, you are paying a higher premium, which raises the bar for how much the stock needs to move just to break even. On the other hand, less volatile stocks might have cheaper premiums, but the likelihood of sharp price moves is lower, reducing the probability of large gains. This adds complexity to the decision-making process and highlights that options are not just about direction. They are about probability, timing, and pricing all working together. For a beginner investment, the risk-reward trade-off of call options can feel like walking a tightrope. On one side, you see the potential for huge gains with minimal capital, and on the other side, you face the possibility of losing everything you put in. The discipline lies in understanding that options are not guaranteed wins and that the leverage cuts both ways. The most successful traders use call options not as lottery tickets, but as carefully calculated plays where the reward justifies the risk. Investment. They go into every trade fully prepared for the possibility of losing their premium, and they size their positions accordingly so that one loss does not wipe out their portfolio. Ultimately, the real challenge is psychological. The excitement of seeing a small investment double, triple, or even grow tenfold can easily tempt beginners to overlook the fact that options can expire worthless faster than they expect. Balancing the thrill of potential reward with the acceptance of real risk is what separates those who use call options effectively from those who treat them as a gamble. The key is to respect the leverage, understand the time sensitivity, and never risk money you are not prepared to lose, because the risk versus reward trade-off is not a hidden detail. It is the very foundation of options trading. One of the easiest ways to make sense of call options is to look at them through real-life examples that go beyond charts and numbers. Imagine you come across a house in your neighborhood priced at $200,000, and you strongly believe that in the next 6 months, the housing market will rise because a new shopping mall and school are being built nearby. Investment. You don't have the money right now to buy the house outright, but you don't want to miss the opportunity if the value climbs. So you make a deal with the owner. You pay them a $5,000 today for the right, but not the obligation to buy the house at the $200,000 anytime within the next 6 months. If the housing market booms and the house value jumps to $250,000, you can exercise your right and buy the house at $200,000. Creating an instant gain of $50,000. If the value of the house doesn't move or even drops, you don't have to buy it. You simply lose the $5,000 and you paid for the right. That's a call option in real estate terms, and it mirrors exactly how call options work in the stock market. Now let's apply this to the stock market itself. Suppose you're interested in Apple, which is trading at a 150 per share, and you think a new iPhone launch will boost the price. But instead of buying 100 shares for $15, and you buy a call option contract that gives you the right to purchase Apple at a 150 per share within the next 3 months. This option costs a $500. If Apple rises to 170, your call option now has a 20 per share of intrinsic value, meaning the contract is worth a $2,000. After subtracting the $500 premium, you've made a profit of a $1,500, which is a 300% return. On the other hand, if Apple stays at a 150 or drops below it by the expiration date, your call option expires worthless, and you lose the $500 premium. You never own the shares. Investment, but you controlled the right to profit from their movement with much less money up front. Another example can be drawn from the world of entertainment. Imagine your favorite band announces a concert, and tickets are $100 each. You believe demand will skyrocket, so you buy an advance option from a broker for $10 that gives you the right to purchase a ticket at $100 anytime in the next 3 months. If tickets sell out and the resale price jumps to $300, your option becomes extremely valuable because you can still buy the ticket at $100. In this case, you could exercise your option, purchase the ticket, and immediately resell it for $300, making a $200 profit. Or you could simply sell your option to someone else who wants that deal. If ticket demand doesn't rise, you let the option expire, and the most you lose is the $10 you paid up front. This concert ticket analogy is often used to explain options because it's something almost everyone can relate to. Locking in a deal before the rest of the market realizes how valuable it is. Even in everyday shopping, there are similar situations. Think about a store that allows you to put an item on layaway. Good investment. You pay a small deposit to reserve the item at today's price, even though you won't complete the purchase until later. If the item's price increases in the meantime, you benefit by still paying the original locked-in price. If the price doesn't go up or you decide you don't want it, you lose the deposit but walk away without further obligation. This is essentially a consumer-level version of how a call option works. The point of these examples is to show that call options are not as foreign as they may seem at first glance. They exist in different forms all around us, from real estate deals to event tickets to everyday shopping arrangements. In each case, the principle is the same. Everything makes a good investment. You pay something upfront to secure the right to buy later at a fixed price, hoping that the value of what you want to buy increases so that your locked-in price becomes a bargain. Investment. What makes the stock market version unique is that it's standardized, tradable, and tied to precise time frames and strike prices. By thinking of call options in these real-life terms, beginners can more easily grasp the concept and see why they can be such powerful financial tools when used with care. Investment. One of the first mistakes beginners make when trading call options is treating them like lottery tickets. The allure of turning a small amount of money into a large profit very quickly is strong investment, and it often blinds new traders to the realities of risk. Many beginners jump into buying out of the money call options with short expiration dates because they are cheap and thinking the stock will make a big move in their favor. While this can work on rare occasions, most of the time those options expire worthless because the stock either doesn't move fast enough or doesn't move in the right direction. The result is a quick loss of the entire premium paid investment, leaving the trader frustrated and confused about what went wrong. Another common mistake is ignoring the time element of options. Unlike stocks, which can be held indefinitely, options have expiration dates. Investment. This ticking clock creates pressure because even if you are right about the direction of a stock, you also have to be right about the timing. A stock that you believe will rise might eventually do so, but if it happens after your option expires, you still lose. Many beginners underestimate the power of time decay, which steadily erodes the value of an option as it approaches expiration. They hold on to contracts too long, hoping for a last-minute rally, only to watch the option's value evaporate before their eyes. Overconfidence is another trap that beginners fall into. After a single successful trade, they may assume they've unlocked the secret to options trading and begin risking larger amounts of money without fully understanding the strategies. This can lead to devastating losses because options magnify both gains and losses. A disciplined trader knows that one win doesn't guarantee future success, and consistency comes from managing risk over many trades, not swinging for the fences every time. Beginners who chase big profits too aggressively often end up blowing through their capital in just a handful of trades. Failing to understand volatility is also a serious mistake. The price of an option isn't determined only by the stock price. It is heavily influenced by implied volatility. If a stock is expected to be highly volatile, the options on that stock will be more expensive. Many beginners see a stock making big moves and assume buying calls will guarantee profits, but they fail to realize that the high option premiums make it harder to come out ahead. Even if the stock rises, the option might not increase as much as expected if volatility drops after the event, such as earnings announcements. This phenomenon, known as volatility crush, often catches new traders off guard and leads to losses even when they guess the direction correctly. Lack of diversification is another problem. Beginners often concentrate too much money on a single call option trade and hoping it will pay off. Since the probability of success on short-term speculative options is low, putting all capital into one trade is reckless. Experienced traders spread their risk across multiple positions and strategies, but beginners frequently go all in and then learn the hard way how unforgiving the options market can be. This ties back to money management. Never risking more than you are prepared to lose on a single trade is a principle that should guide every beginner. Another mistake is neglecting to have an exit plan. Too many beginners enter a trade without knowing when they'll take profits or cut losses. They either panic when the trade turns against them or get greedy when it goes in their favor, waiting too long and watching gains evaporate. Successful trading requires clear rules, deciding in advance how much you're willing to risk, what profit target you'll accept, investment, and when you'll walk away regardless of emotion. Beginners often fail to set these rules and end up making decisions driven by fear and greed, which usually leads to poor outcomes. Finally, many beginners misunderstand the purpose of options altogether. They see them only as speculative tools instead of recognizing their role in risk management and hedging. Investment options were designed to manage uncertainty and provide flexibility, not just to gamble on short-term price swings. By approaching them with a get-rich-quick mindset investment, beginners put themselves in positions where the odds are stacked against them. The smarter approach is to treat options as a supplement to a broader investment strategy, not the entire strategy itself. All of these mistakes stem from a lack of preparation, discipline, and respect for the complexity of options. Education, practice, and patience are the antidotes. By learning from these common pitfalls, beginners can avoid unnecessary losses and start to build a foundation for using call options wisely, not recklessly.